Welcome to the Old Republic Risk Management webinar, Loss Forecasting, How Do I Use My Actuarial Reports? My name is Kevin Trular, and I'm an account executive located in Chicago with Old Republic Risk Management. As you know, Old Republic Risk Management writes large primary casualty insurance programs. Our customers typically retain the working layer of losses via formal self-insurance, large deductibles, or captive reinsurers. Predicting those working layer losses is often an assignment for both insurer and insured. That leads us to today's webinar. I'd like to introduce our presenters. With me today is Jennifer Q. She is an actuarial manager at Old Republic General Services. She has worked in a variety of actuarial roles over the past 13 years, including personal and commercial lines pricing and catastrophic modeling. She currently spends most of her time working on large account pricing for Old Republic Risk Management. Also with me today is Travis Grokowski. He is Principal Actuary, Consulting Actuary at Milliman. He has 18 years of property and casualty actuarial experience. Travis specializes in assisting self-insured corporate clients, determining proper funding and reserving levels, allocating costs to divisions, and analyzing collateral requirements. Before we begin today's webinar, we're obligated to share with you our disclaimer page. Also, just as a reminder that if you'd like to ask questions during the webinar, please use the question and answer area in the control panel. You can submit questions at any time during the webinar, and we'll try to respond to any of those questions not answered during the webinar at the end of the presentation. In this webinar, we plan on covering background on actuarial reports, explanation of the models, some usable tips, and the typical results. At this time, I'd like to turn it over to Jennifer and Travis.
Thank you, Kevin. We decided to put together this webinar for our business partners because we know that loss picks can be an important component in the insurance costs for large accounts. Travis and I would like to give you an actuary's perspective on how we get to our selections. We'll start out giving you a little background, and then we'll give an overview of some of the models we use. We'll point out some tips to help you understand the output of these models, and also show you an example with some typical model output.
Actuaries are trained to analyze historical trends that help predict future claim outcomes. We perform a series of calculations using both loss and claim data, industry trends, and other relevant information to calculate ultimate losses. Each method derives an estimate of ultimate loss. What are ultimate losses? Basically, the estimate of ultimate losses is the total dollar amount needed to pay all claims for a particular policy or accident year. When an actuary calculates an ultimate loss indication and then subtract out the amount paid for a particular year, an unpaid estimate or total reserve is calculated, and that reserve is made up of two primary pieces of information: the case reserve for known claims plus IBNR, which is the incurred but not reported. Actuaries also calculate loss forecasts, and these are used for future fund year estimates, which can be used for pricing or collateral estimates. We'll also talk about previous estimates. Oftentimes when an actuary does his or her work, they want to know how much ultimate losses have changed year over year and what causes these changes. So the reserve or the unpaid loss estimate is often the largest liability on a balance sheet, and to calculate the ultimates or the reserves, actuaries need data, and oftentimes a lot of data. So Jennifer will go into some of those key data components now.
You're probably familiar with most of the types of loss that are listed on this next page. So I'm not going to go into detail about all of them, but these are the key building blocks for most of our actuarial models. Sometimes we analyze loss and expenses together and sometimes separately. It's most important for us to have expense data split out from the loss data when the deductibles or the policy limits are pro rata or not inclusive of ALAE. Travis already mentioned the difference between case reserves and IBNR, but I want to come back to that to point out the difference between incurred losses and ultimate losses. Incurred losses are paid losses plus case reserves, which are the reserves set by claims staff. The difference between incurred losses and ultimate losses is IBNR, or incurred but not reported. The amount of additional development is typically selected by an actuary. When we refer to unpaid losses, we're talking about the sum of these case reserves and the IBNR reserve. Personally, when I see a big change in unpaid amounts year over year, the first thing I check is to see whether the increase or decrease is coming from the case reserve or from the IBNR reserve. Case reserves are set at an individual claim level, so we can drill down and get some detail on why they've increased or decreased, whereas IBNR is set at an aggregate level, and it's driven by our model selection. Recoveries usually refer to salvage and subrogation, but occasionally we see data that includes other recoveries. An actuary can typically use data that's either gross or net of these recoveries, but it's important that we know what is included in the data we have. I had an account I looked at recently that included excess carrier recoveries together with the salvage and subrogation data. Because there was no footnote explaining what was included, it looked like there was an inordinate amount of subrogation on this account. We were ultimately able to figure out why the recoveries looked so high in this case, but in general, being really clear about what's included can help save time for all the parties involved. Claim counts are not a necessary data input for most of the basic actuarial models, but it is a really good reference point for us, regardless of whether it's required for the models we've selected. Accounts with large numbers of open claims tend to have more development potential than accounts where almost all the claims are closed, so it's something we like to refer to. Exposures are an important piece of actuarial models, especially in projected year loss forecasts, where we develop a loss rate per exposure unit that will then apply to the projected exposure units. We've listed the most common exposure bases for commercial lines right here. However, sometimes we find that a different exposure base, such as miles driven or square footage, is more appropriate for certain accounts. Basically, we want to select an exposure basis that's reflective of the loss potential. Next, Travis is going to walk us through a loss development triangle.
So Jennifer mentioned that incurred losses is equal to paid losses on known claims plus case reserves. So this exhibit here shows how a typical group of claims develop or change over time. What is down the column are policy years, and across the top row are months of development. So it shows how a group of claims change or behave over time, and they can be influenced by many different factors, including legal trends, large or shock loss claims, case management, etc. They all have an influence on how claims or losses develop over time, and it's the actuary's job to predict how those claims will develop in the future. So in a nutshell, that's what an actuary does. They select factors for each stage of development, multiply those factors by the latest point of development that will produce an estimate of ultimate losses. So to give you an example of how the calculation works, if you look at the top row of numbers for policy year 2000 and take the 2 points in time at 24 months divided by 12 months, so in other words, the 2,869 divided by the 1,009, it gives you the point on the bottom triangle for the policy year 2000, the 12 to 24 factor of 2.843. This means that a loss at 12 months of development will tend to develop 2.8 times when it reaches 24 months of development. The calculations that follow below is done in a similar fashion, and it shows how each point or each group of claims at a particular point in time tends to develop over the next point in time. And so when an actuary analyzes this triangle, and then what they would do is make selections based on how they anticipate these losses to develop in the future, and the very bottom two rows shows what has been selected for this particular accident year development triangle, and then the losses are, or the factors are accumulated or multiplied together. And then what is done is we take, for example, I'll utilize the 12-month and 24 months of development to illustrate how these ultimates are calculated. So if you go to the top triangle, the bottom number at 12 months of development is 1,585. If you multiply that by the cumulative factor at the bottom of the page at 12 months of development, or the 5.268, that gives an ultimate indication of 8,350. The very next point, the 24-month factor of 3,242, multiplied by the cumulative factor at the bottom of 1.53, gives an ultimate of 4,961. I'll display later how these ultimates are compared to the other methods, but in a sense, we're looking at this. This is just one way or one method an actuary looks at, and there's a way to balance kind of how the experience looks as well as the exposure, and we'll talk a little bit about how these different methods and what each of the methods mean next.
One of the first things we do when we start an actuarial analysis is to check the data carefully to assess its reliability. For a program that we've looked at previously, we'll compare the data year over year to see if it looks consistent. An error that's rather easy to detect right away is a decrease in paid amounts. Usually, if we see that paid losses or expenses have decreased, it means something's missing from the data set. We also like to check whether the data is consistent with itself. Typically, we receive data summarized by policy year as well as a separate large loss listing. I've had quite a few instances where the large losses in a particular year exceed the summary amount. This could be because summary losses were limited, but it could be a sign there's a data problem. Either way, it's something we need to sort out before starting an analysis. Program changes are another instance where we should consider whether the data provided is appropriate for our loss analysis. If the structure of a company changes because of an acquisition or divestiture, it's important that we know what pieces are included in the data sets provided. Ideally, at the time of a merger, we want to look at two separate data sets. For loss estimates on the prior years, we want to include just the insurance liabilities we were actually responsible for prior to the acquisition. But for the projected year loss forecast, we really want to base our forecast on losses from both the original and the acquired company together. There are some instances where the distinction between the two data sets is not particularly meaningful. I usually assume that if the acquisition is small, or we have reason to believe that the operations and loss potential of the acquisition is very similar to that of the original company, it might not be necessary to include the historical data for the acquired company in our forecast analysis. Actuaries like to look at how stable losses are. It's easier to select ultimate losses for accounts when we have very stable loss patterns. If we do see jumps or drops in loss values, we should investigate the reason for this odd development. In some rare cases, we may decide that a particular claim or set of claims is so atypical or so unlikely to reoccur that we'll actually exclude those losses from our loss projections. Travis is going to take us through some of the actuarial loss methods available.
So the first two methods are the incurred loss development method and the paid loss development method. And like the example I just walked through on the incurred development triangle, the paid development method is done in a similar fashion where the paid losses are analyzed over successive 12-month or 6-month development periods. Factors are selected, and then the factors are accumulated to produce an ultimate indication. And the latest evaluation of paid losses are multiplied by these cumulative loss development factors to derive an indication of ultimate losses. So these are the two basic methods, triangle-based methods, that an actuary would analyze when developing ultimate losses.
I'm going to talk about the frequency-severity method next. The premise of this method is to split the total loss into two components: the frequency, which is the number of claims per exposures, and the severity, which is the average size of loss per claim. We estimate the two components separately, and then we multiply them together to calculate the total loss. This is one of the few methods that requires claim count information. So whether or not that's available can be a determining factor of whether we can use this method. This can be a really good method to explicitly reflect trends in loss frequency or severity. It can also be useful for lines with very infrequent loss activity, and it can be useful in less mature recent policy years. Another method is called the pure premium method, and it's one that's also useful for accounts with little or no loss activity. Most of our clients are large enough that we prefer to rely on their own loss experience. However, the pure premium method can be useful for new companies or for accounts with little loss info for a particular line of business. We simply multiply the exposure base by a manual rate. Even in cases where plenty of loss data has been provided, this is a good method for us to use as a reasonability check. I remember an account I worked on that had separate insured and self-insured programs. When I compared the loss rates that I calculated to the pure premium manual rates, one of them was much higher and one of them was much lower than the pure premium rate. Comparing to the pure premium method made me realize that some of the self-insured data had accidentally been included in the insured data set. So once again, it's a good method to use for reasonability check.
The final set of methods are referred to as Bornhuetter-Ferguson methods, or BF methods, and they really are a blend of looking at the actual experience as well as some prior or a priori expected ultimate indication. An actuary, when they look at a group of claims year over year, they will have an a priori estimate of what the ultimate losses should be. And so that is used in this method, and then the actual experience in the most recent 12 months or 6 months, whatever the development period is factored in or weighed into the method, and then an appropriate ultimate indication is derived. So now we come to looking at the differences between the models. When are they used? I'll go very briefly through each of the methods again, and then look at an example of how an actuary may look at the models and may end up selecting estimates based on a review of the models. So the next exhibit shows kind of a typical display of the various methods we discussed: the incurred loss method, the paid loss development method, the Bornhuetter-Ferguson projections, and then the pure premium and frequency severity projections. And the very last column here displays what an actuary may select for an ultimate loss indication. So when we look at the merits of each of the various methods, I'll focus on first the development methods, the paid and the incurred development methods. And focusing on the incurred method first, as we recall a few slides ago, we talked about how the incurred loss development method produces estimates of ultimate loss. And we came up with, for the most recent 2 policy years, $8,350 for 2013 and $4,961 for 2012. And as you can see on this exhibit, I've highlighted these as a high estimate for 13 and a low estimate for 2012. And this occurs because the development factors themselves are so leveraged. And what I mean by that is that these years are very immature. And so to predict how a paid loss or an incurred loss at an immature stage of development will eventually develop to an ultimate base, there's just too much uncertainty. And so a low amount of paid loss or a low amount of incurred loss in an immature point in time is multiplied by a factor that is relatively high compared to the other accident years. And so you get an ultimate that it can be very low or very high because of that. And conversely, the paid projection is showing the opposite impact. For 2012, the paid method is actually showing a much higher indication than the 2013 is coming up with a much lower indication. So typically an actuary will ignore these methods for immature policy periods. And it's just because of that reason that the development factors are much too high, and so the impact is a very leveraged outcome. So we would shift to some of the other methods for the most recent years, like the Bornhuetter-Ferguson method, which is a blend of kind of the a priori expectation as well as the actual industry, as well as the actual claim experience that has come in over those 12 months. Or they would move to the pure premium or frequency severity method as displayed in columns 8 and 9. And as you can see, the pure premium method for this particular example has come in very close to what is actually being selected in column 10. Obviously, these selections rely on judgment. Large losses impact that, work comp trends impact these, new exposures, and so the ultimate selection relies on an actuary's judgment. And Jennifer will discuss some of these judgment calls that are made when going through these types of analyses.
So if actuaries are all using the same methodologies, how come we're always coming up with different estimates? Well, there are a lot of areas of these analyses that require some degree of judgment, as Travis mentioned. Loss development factors are one of these areas. In the loss triangle example that Travis shared with us, he showed several different averages down at the bottom of the page, and he could have chosen from any of those averages when he was selecting his final factors. Another important part of the loss triangle selection is the tail factor. Just because we only have 14 years of account-specific loss data doesn't mean there won't be any additional payment activity after those 14 years are up. Workers' comp claims can continue to pay out for decades. Typically, we refer to industry factors in addition to the account experience when we're selecting tail factors. Before we start making loss development factor selections, it's also important to consider whether the account's development patterns are even credible enough to use. Factors an actuary would consider are the stability of the development patterns, the number of years provided, and the volume of data in each year. The mix of business can also be important for selecting development or trend factors, since different industry factors exist by vehicle weight class for auto, as well as industry type for general liability. We haven't really discussed trend factors much yet, but basically they're factors that account for differences in claim size and frequency over time. We typically rely on industry sources when we select our trend factors. However, I have seen actuarial reports where trend selections are made based on the account's own loss info, which may be appropriate depending on the size of the data set. Once all of these factors have been selected, the final area of judgment is how much weight to give to each methodology. Travis just kind of talked us through that example page where he was showing the different methods and showing which would be more appropriate in different years. When I sit down with someone else's actuarial report, I try to evaluate how reasonable the loss estimates look to me. Some of the things that are worth considering are, did the actuary identify trends? If the losses are deteriorating year over year, is this reflected in the projected loss rate, or did they just simply take an average across all the years? Look at how much weight is given to particular years and models. As we mentioned before, some models are more appropriate in greener years, others are more appropriate in developed years. Another thing to consider is whether one year appears to be an outlier from the rest of the loss history. If one year looks atypical, it might make sense to exclude it or to give less weight than the other years. Check to see if the selected estimates look reasonable. If you notice that an actuary is always selecting the highest method or the lowest method, the final result might be overstated or understated. Getting back to my question earlier about why all actuaries can't come up with identical loss estimates, it's important to keep in mind that different parties are viewing loss estimates from different perspectives, and they want to incorporate different levels of conservatism. An insurer who's calculating a collateral need is trying to estimate the amount that will be necessary to cover losses in a bad situation when an insured is struggling financially. It would be reasonable for us as the insurer to make a more conservative selection than a consultant for the insured would, because they might be interested in helping reduce collateral costs for the insured. Our goal as actuaries is not necessarily to all arrive at the same number, but hopefully with a good understanding of the models and what goes into them, we can have an educated discussion about the different estimates and come up with a business decision that all parties can feel comfortable with.
All right, at this time, we've gotten a couple questions that have come in. So again, Travis and Jennifer, thank you much. One of the questions we received in was, if all the claims in a given year are closed, why is there still projected outstanding losses?
Well, I think we already talked about that a little bit with the loss development triangle and the discussion of a tail. But basically, it's important to keep in mind that payment activity is going to continue. And in some of the other coverages, maybe auto liability, for example, claims can reopen even if you're not seeing additional payment activity year after year. So it's always important to keep in mind reopening is a possibility.
I would agree with Jennifer. Some jurisdictions or states may open case law, or cases get retried, or a person with a bad back injury may have another surgery and you might need that work comp claim might get reopened. So the potential for a reopened claim is real, and the actuary has to factor that in.
Great, thanks. One of the other ones that we did have in here is, how typically does an actuary adjust the loss development factors? And I guess, how do you typically decide what LDFs to use?
I like to look at selecting loss development factors once per year. Some of our clients, we would look at loss data every 6 months, but I typically don't adjust the loss development factors unless claim experience dictates that we do look at it. I like to look at it once a year and then interpolate in between those points in time to come up with average factors for the 6-month point in time. But generally speaking, once a year is often enough to make sure that you're responsive to the activity, but your triangle and your factors remain stable over time.
That's another question then as well as, how often, or when you're looking at contemplating in the calculations any loss aberrations or changes in exposure, and I know you may have touched on that a little bit, but maybe just expand a little bit maybe on the aberrations.
Again, I guess I like to go back to the client and discuss any large losses or odd things that are maybe happening. Sometimes when you're looking at an aggregate triangle, like we looked at before, a large loss might not be readily seen unless you can kind of go drill down into the detail. But sometimes a large loss will be obvious when looking at a triangle. You may see a factor that's twice all the other factors. And so there, I think it's imperative that you have a discussion with the client and try to understand what is driving that aberration. So you either can pull it out of the experience and not develop it, or you truly want to understand if it's a one-time event or if it's something that could have happened in the future.
Exactly. And I agree with Travis. We try to dig down as carefully as we can to figure out what the source of a big blip is. And sometimes it's coming from a single claim. Sometimes it's coming from a particular state. So those are the sorts of things we try to figure out. Where is this coming from? Has something strange occurred, and is that likely to occur again?
I would even add that the case reserving philosophy is different by every client you look at. I had one client that after they assumed a claim would not reopen after 10 years, So in that case, you would expect a development factor of 1 to appear after 10 years, which, as we can see, for a lot of coverages is not really the case. Claims reopen or claims continue to pay. So you really need to understand the case reserving philosophy of your particular client and how it may impact the judgment you impart on the actuarial work.
Great. Well, I guess we've got one final question here. How many years of the triangle data is needed for the triangles to be useful?
I typically am looking for 10 or more years of data. It does depend if it's a really large client that has a lot of volume of data. We might be able to use fewer years, but we're generally going to need to somehow piece that together with industry experience to create a full data set. I'm normally also looking for at least $1 million of losses in a particular policy year for me to consider a loss triangle credible. I think Travis just was mentioning about changes in exposure or aberrations, and I think that also applies here with the triangles. Sometimes there'll be something that'll happen. Maybe there's a merger, a divestiture, the claims management team changed. These can cause some sort of a blip in the triangles, and that's something else that we want to consider. If something really major happened 5 years ago, maybe that means we don't really want to rely on those years that were older than 5 years. It's good to see as a reference point, but that's something else that we try to take into consideration.
I would agree with that. And another thing we didn't discuss a lot is how much retention can change from time to time. If the client is retaining $500,000 per work comp claim and they move to a $1 million retention, that also needs to be considered when looking at development factors. And in that case, sometimes I'd like to bring in certain industry factors. So if my client is a manufacturer, I would try to use relevant manufacturing client industry data to help select loss development factors. You wouldn't want to use retail factors or non-manufacturing because the work comp claims and general liability product claims can have real distinct loss development patterns based on the type of exposure. So to the extent we can, we try to bring relevant industry patterns to help look at when we're analyzing client data.
Excellent. Well, I'd like to thank everybody for attending today's Old Republic Risk Management webinar. Just as a reminder, today's presentation has been recorded and will be available on the Old Republic Risk Management website at www.orrm.com in the download section. If you'd like a copy of the slide presentation, please email us at gotowebinar, all one word, at orrm.com. There's going to be a short survey that will be sent out to everyone. If you have time, please fill it out. We'd really appreciate the feedback. Once again, on behalf of Jennifer, Travis, and myself, we'd like to thank you for attending today's webinar.